Did you know that Australia now has some of the highest household debt in the world, even surpassing the United States and the United Kingdom? For years, Australians have stretched their finances to the limit just to achieve the housing dream. But what if that dream is on the verge of collapse? What if the long-held belief that the property market is safe turns out to be dangerously wrong? Experts are now warning that Australia's housing market could crash by 2026. The warning signs are mounting: rising interest rates, increasing mortgage defaults, and foreign investors pulling out. Yet most Australians remain oblivious, distracted by record-high property prices and ignoring the cracks forming beneath the surface. In this video, we reveal 10 shocking reasons why the Australian housing market could crash, and one of them may surprise you. Watch closely. Knowing these risks could protect your savings, your home, and your financial future. Before we get started, make sure you're subscribed to Housing Watch and turn on notifications so you don't miss what's coming next. Subscribe for clear, data-driven insight into housing market. Your support really helps the channel grow. Tap like, share your local experience in the comments, and buckle up. Now, start the engine. We have a lot of miles to cover. Number 1. Interest rate pressures. A major warning sign for Australia's housing market. One of the biggest red flags for Australia's housing market right now is the relentless pressure from rising interest rates. After years of historically low borrowing costs, many homeowners are now facing a harsh reality. The Reserve Bank of Australia has been aggressively increasing rates to fight inflation, and these hikes are creating a dangerous ripple effect across the property sector. Higher interest rates mean higher mortgage repayments, and for many Australian families, this now takes up a significantly larger portion of their monthly income. Recent reports reveal that over 1 in 4 households are already experiencing mortgage stress, struggling to meet their home loan payments. This is a serious warning that the market may not be as stable as it appears. Consider the implications. When thousands of people can't afford their homes, some are forced to sell, while others default. When this happens on a large scale, property prices can decline rapidly. Adding to the risk, many recent buyers locked in ultra-low fixed rates that are now expiring. As they switch to higher variable rates, their repayments could jump by hundreds or even thousands of dollars each month. This growing financial pressure could push a wave of homes back onto the market, increasing supply just as demand weakens. It's exactly the kind of scenario that can push a housing market from stability into a sharp decline. And it's no longer just a theory. Understanding this risk is critical if you want to protect your home, savings, and financial future. Number 2. Stagnant wage growth. A hidden threat to Australia's housing market. While housing prices in Australia have skyrocketed over the past decade, wage growth has barely kept pace. This growing gap is a clear warning sign that the market is being propped up by debt, not sustainable income growth. When the average Australian's paycheck doesn't rise in line with the cost of living, financial strain becomes inevitable. Recent government data shows that real wage growth in Australia has been stagnant for years. After adjusting for inflation, many Australians are actually earning less than they did just a few years ago. Meanwhile, property prices have continued to climb, making homeownership feel increasingly out of reach, especially for first-time buyers who have already stretched their budgets. Imagine this: mortgage repayments are rising due to interest rate hikes, but your wages remain flat. For many families, keeping up is already becoming impossible. As wages stagnate, fewer buyers can afford today's inflated home prices, shrinking the pool of potential buyers. This imbalance puts enormous pressure on the market and threatens its long-term stability. The worrying part? This isn't just a temporary trend. It's a long-term pattern. Without strong wage growth, one of the housing market's key pillars disappears. When people can no longer pay higher prices, property values have nowhere to go but down. If this wage-price gap continues to widen, it could become a major trigger for a housing market crash in 2026, putting homeowners, investors, and the broader economy at risk. Number 3. Declining consumer confidence. A silent threat to Australia's housing market. Another major warning sign for Australia's housing market is the sharp decline in consumer confidence. When Australians stop believing that property prices will continue rising, the market can shift quickly. Confidence isn't just about optimism. It directly affects whether people are willing to spend, invest, or take on big financial risks like buying a home. Recent consumer sentiment surveys reveal growing pessimism about the economy and the future of the housing market. Increasingly, potential buyers are choosing to wait, fearing they could purchase at the peak and be left with a falling asset. When this mindset spreads, demand dries up, and home prices begin to soften. Think about it. Would you rush to buy a house if you expected it might be worth less next year? Most likely not, and that's exactly what's happening across Australia. Reports from major banks show new loan applications slowing, and open house inspections are attracting fewer visitors. This hesitation can snowball quickly. As buyers step back, sellers often panic, lowering asking prices to attract interest. Consumer confidence is the invisible fuel that drives the housing market. Without it, the market can stall, or worse, reverse sharply. What makes this particularly concerning now is that declining confidence is being driven by multiple pressures: rising interest rates, stagnant wages, and fears of an economic slowdown. When Australians lose faith in housing as a safe investment, it can trigger a chain reaction, pulling property prices down. And that's exactly the risk the market faces heading toward 2026. Number 4. Rising mortgage defaults. A dangerous sign for Australia's housing market. One of the clearest warning signs that a housing market crash could be looming in Australia is the steady rise in mortgage defaults. When homeowners begin missing repayments in large numbers, it often marks the first serious crack before a market collapse. And right now, those cracks are appearing across the country. Recent data from Australian banks shows mortgage arrears quietly climbing. Many homeowners are falling behind on repayments as interest rates rise and the cost of living continues to surge. A large portion of these homeowners borrowed heavily when rates were at historic lows, expecting stable monthly payments. But now, as fixed-rate deals expire, borrowers face sudden spikes in repayments, sometimes hundreds of dollars more per month, without any increase in income. For many Australians, this is no longer just a fear, it's a harsh reality. When defaults rise, banks are forced to repossess homes and sell them quickly, often at reduced prices. This floods the market with supply, driving property prices down even further. Falling prices then trigger more panic selling, creating a vicious cycle that can accelerate a market downturn. Mortgage defaults aren't just a financial issue, they're a clear signal that the housing system is under pressure. If this trend continues, we could see a wave of forced sales hitting the market by 2026, sharply reducing home values and threatening the stability of Australia's property boom. For homeowners, investors, and first-time buyers, understanding this risk is critical to protect their investments, savings, and financial future. Number 5. Shrinking overseas investment. A key risk for Australia's housing market. For years, foreign investment has been a major driver of rising Australian property prices. Buyers from countries like China, Singapore, and the United States poured billions into high-end homes and inner-city apartments. But now, that strong flow of overseas money is slowing. and the market is starting to feel the impact. Recent government data shows foreign investment approvals have dropped significantly, especially after stricter regulations were introduced. Global economic pressures, rising interest rates abroad, tighter capital controls, and international uncertainty are also making investors hesitant to park their money in Australian real estate. What does this mean for local buyers and sellers? Less foreign demand means reduced competition, removing a major source of price growth, particularly in cities like Sydney and Melbourne. Developers who once relied on offshore buyers are now struggling to sell new properties, often having to cut prices to move inventory. The ripple effect is broader than just sales. A decline in overseas investment can shake market confidence, slow new construction, and even influence rental prices. Without this major pillar of support, the housing market becomes more exposed and vulnerable to a correction. If this trend continues, Australia could be heading toward a housing market correction, or worse, a crash, by 2026. Paying attention now could help protect your home, savings, and investments. If you found this insight valuable, hit that subscribe button and share your thoughts in the comments. Do you think the housing market will crash or bounce back? We'd love to hear your perspective. Number 6. Oversupply in key markets. A hidden risk for Australia's housing market. A silent but growing threat to Australia's housing market is oversupply, particularly in major cities like Melbourne and Brisbane. For years, developers raced to build high-rise apartments and sprawling housing estates, confident that demand would always outpace supply. But that assumption is starting to fail. Recent data shows that in certain areas, especially inner-city apartment markets, supply now far exceeds demand. Thousands of units sit empty or unsold as developers struggle to attract buyers or tenants. This growing inventory is a serious warning sign, because when there are too many homes and not enough buyers or renters, property prices are forced to drop. Think about it. Developers and investors who overcommitted during the boom are now facing vacant properties and falling rents. To recover their investments, many begin cutting prices, creating downward pressure across the market. As more properties hit the market, buyers start expecting bargains, accelerating price declines. Oversupply doesn't just affect sale prices, it impacts rental yields, increases financial stress for developers, and can even slow new construction, weakening the housing sector from within. If this oversupply trend continues, particularly in urban hubs, it could flood the market by 2026, triggering a sharp housing market correction that many homeowners and investors aren't prepared for. Oversupply is a slow-building risk, but once the balance tips, it can have rapid and painful consequences for property prices, rentals, and market stability. Number 7. The hidden impact of population slowdown on Australia's housing market. For years, population growth has been a major driver of Australia's housing market. More people mean higher demand for homes, both to buy and rent, pushing property prices upward. But now, a quieter, less discussed factor is emerging. Population growth is slowing down, and this could have major consequences for the property market. Recent statistics show that net migration, the number of people moving to Australia minus those leaving, is dropping sharply. This slowdown is driven by tighter immigration policies, global uncertainties, and lingering pandemic-related border restrictions. At the same time, declining birth rates mean fewer new Australians are entering the housing market naturally. Simply put, fewer people are needing homes. Why does this matter? A slower growing population directly reduces long-term housing demand. With fewer new residents, developers struggle to sell new builds, and existing homeowners may face stagnant or falling prices. This trend is a slow-burning risk. It doesn't trigger an immediate crash, but steadily erodes the market fundamentals that have supported high prices for years. As demand weakens, price growth slows and can eventually reverse. Many analysts now believe that this quiet shift in population dynamics will be one of the key factors behind a potential housing market crash in 2026. For anyone tracking Australia's property market, this is a trend you cannot afford to ignore. Understanding the long-term impact of population slowdown could help you make smarter decisions about your home, investments, and financial future. Number 8. Government intervention backfiring. How policies may be fueling Australia's housing crisis. Across Australia, governments have introduced various programs to support the housing market, particularly for first-time buyers. Grants, subsidies, and low-deposit loan schemes were designed to make homeownership more accessible. But experts are warning that these well-intentioned policies might actually be inflating property prices and creating new risks. When the government injects extra money into the market, it often creates artificial demand. First home buyer grants, for example, encourage more people to buy quickly. But increased buying power can push sellers to raise prices, knowing more money is chasing the same number of homes. The result? Homes become even less affordable over time. Low deposit loans let buyers enter the market without saving significant deposits. While this seems helpful, it also increases financial risk. If property prices stall or drop, many of these buyers could struggle with repayments, leading to mortgage defaults and forced sales. There's also the unintended effect of distorting market signals. Instead of letting prices adjust naturally based on real supply and demand, government incentives can create localized housing bubbles. When the support fades or is removed, these bubbles can burst, triggering sharp price corrections. In short, while government programs aim to help, they can unintentionally increase market vulnerability. If such interventions continue without careful planning, they could contribute to the predicted housing market crash in 2026. Understanding the full impact of government policies is essential if you want to see where Australia's property market is truly headed and protect your home, investments, and financial future. Number 9. Rental market volatility. Another threat to Australia's housing market. The rental market is a critical part of Australia's overall housing landscape, and right now, it's showing clear signs of instability. In recent years, rents have surged dramatically, particularly in major cities like Sydney and Melbourne. While higher rents may seem like good news for landlords, the reality is that this volatility could ripple back into the broader housing market, increasing the risk of a crash. Rising rents place immense pressure on tenants, many of whom are already struggling with high living costs. This strain can increase demand for government support and spark calls for stricter rental regulations. In response, governments may implement rent caps or stronger tenant protections, which can reduce the profitability of rental properties. For landlords and investors, unpredictable rental income often leads to reconsidering property investments. Many may choose to sell rental properties or delay new purchases, reducing demand in the housing market. Lower demand can stall property prices or even push them down. At the same time, rising rents and economic uncertainty can delay first-time buyers from entering the market, shrinking the pool of potential homeowners. Some investors may also offload rental properties that are no longer yielding strong returns, increasing supply and further pressuring prices. In essence, rental market volatility adds another layer of risk to Australia's housing sector. If these trends continue, instability in the rental market could become a key trigger in the predicted housing market crash of 2026, affecting homeowners, tenants, and investors alike. Number 10. Global economic uncertainty, a major risk for Australia's housing market. Australia's housing market doesn't exist in isolation. It's closely tied to the global economy. Right now, the international economic landscape is highly unstable. Geopolitical tensions, supply chain disruptions, rising energy costs, and fears of a global recession are creating a perfect storm of uncertainty that could significantly impact property prices in Australia. Global economic slowdowns in major economies like the US, China, or Europe often lead to reduced foreign investment in Australian real estate. Investors become cautious, preferring safer or more liquid assets, and the withdrawal of overseas capital removes a key source of demand and liquidity from the market. Meanwhile, global inflation and rising energy prices increase costs across the board, from building materials to household bills, putting pressure on both developers and Australian families. Supply chain delays can also slow construction projects, squeeze profit margins, and reduce investor confidence. Geopolitical conflicts and trade tensions further fuel market jitters, sometimes triggering sudden sell-offs or reduced economic activity. For a trade-dependent economy like Australia, these shocks are felt quickly. High uncertainty causes buyers and investors to hold back, delaying major financial decisions and slowing overall housing market activity. In summary, global economic uncertainty is a powerful factor that could accelerate a housing market decline by 2026. Its effects aren't limited to Australia. They ripple across the world. For homeowners, investors, and first-time buyers, understanding these global risks is crucial to protecting investments, savings, and financial security in an increasingly volatile market. Australia's housing market is facing a perfect storm that could trigger a market crash by 2026. Rising interest rates, stagnant wages, shrinking foreign investment, oversupply, slowing population growth, and backfiring government policies are all weakening the market's foundation. Rental volatility and global economic uncertainty add even more pressure. Yet many Australians remain overly optimistic, assuming property prices will always rise. The reality is different. Affordability is falling, financial stress is growing, and confidence is declining. If you're buying, selling, or investing, understanding these 10 warning signs is essential to protect your home, savings, and financial future.